Good morning. This is Dave Toth with an RJO MRT technical webcast update on the US dollar index, the euro currency, the dollar yen, and the gold markets for Thursday, February 10th. Starting off here with a daily log scale chart of the US dollar cash index. You can see the bullish divergence in momentum as a result of the recent recovery above the 78.32 corrective high from January 31st that we believe defines the 76.88 low from February 2nd as the end of the broader past month sell-off from the 81.31 high back on January 10th, exposing at least a larger degree correction of this sell-off and quite possibly a resumption of the sharp rally we had in November from 75.63 up to 81.45 that would suggest new and potentially significant gains above that 81.45 high level. From a shorter term perspective, and another reason that we're increasingly positive on the US dollar index is you can see overnight's recovery from what was a clear three-wave and we believe corrective relapse attempt that perpetuates this basing and reversal threat and defines yesterday's 77.55 low as a tight but objective corrective low from which to base a bullish policy. Another important factor that might have some long-term implications is the US dollar's position at the lower recesses of this contracting triangle that we've been arguing for the past couple of years, and especially at a time when the bullish sentiment condition has eroded to a neutral to even cautiously bearish approach to the US dollar index. And you can see from the MRT bullish sentiment index of large spec bullish exposure reportable to the CFTC, the most recent reading of a 47% is consistent with the recent lows from late September that accompanied that nice base and reversal environment in November. From a March futures perspective, we think traders would do well with a favorable risk-reward opportunity by establishing bullish exposure from current levels and using yesterday's 77.58 low, which is right near the 61.8% retrace of the initial 77 even to 78.44 recovery attempt as a tight but objective risk parameter ahead of further and possibly accelerated gains. So in general, we advise traders to approach the US dollar index from an increasingly constructive perspective, with weakness below at least 77.50 in the cash index and 77.58 in the March futures contract, and especially the 76.88 low from last week basis the cash index to really mitigate this what we think is a larger degree basing and reversal environment. Until such weakness below 76.88 is shown here on a daily scale, we think this the US dollar index could have mountains of upside potential that could span months. Moving to the euro currency, and obviously inversely, given their inverse correlation, you can see overnight's relapse from a 61.8% retrace of the initial counter trend sell-off from 138.63 down to 135.08. That follows a confirmed bearish divergence in daily momentum, shown here on the daily scale by virtue of the market's failure below the 135.70 corrective low from January 31st. That contributes to what we think is a larger degree peaking and reversal threat in the euro, with strength above the 138.63 high from February 2nd required to mitigate this increasingly toppish environment. In sum, a bearish policy is advised in the euro currency with strength above yesterday's 137.45 high required to defer this view, and a break above the 138.63 high from last week required to negate it. Until or unless such weakness is shown, we think this market could have significant losses, with the next pertinent hurdle being the mid 134 handle area as an area of former resistance that now would be expected to provide support if we're wrong on this broader peaking and reversal threat and the euro is still basically strong. If the market breaks this 134 handle, we think it could have sharp losses in the weeks and months ahead. Moving to the US dollar index, and very interestingly, you can see on its daily chart here, what we've been wrestling with over the past few months is the prospect of either a major basing and reversal threat or a lateral diagonal triangle pattern from that November 1st low at 80.23. You can see that alternate waves within this triangle have respected the 61.8% progression relationship. The January sell-off was basically 61.8% of the length of the December break from 84.52 to 80.93, and currently this the past week's recovery has reached the area, the 82-81 area, that makes it 61.8% of the previous recovery from 80.93 up to 83.69. These 0.618 Fibonacci progression relationships are common with contracting triangle patterns, but as a result of this latest recovery, the market has defined the 81.10 low from February 4th as perhaps this market's most important level, if not its second to the 83.69 high from January 7th. For as long as that 81.10 low remains in place, so does the prospect of a major basing and reversal threat that will be confirmed if the market can break above that 83.69 high from January 7th. If the market relapses below 81.10, it will reinforce this lateral triangle consolidation pattern that, within the context of the secular bear trend in the dollar yen, we think would expose emotional and sharp losses to new lows on a long-term monthly scale, shown here, not only below the 80.23 low from back in November, but perhaps below the major April 95 lows of 79.92. While these recent lows remain in place, you can see the prospect of a major basing and reversal threat. We've got evidence of waning downside momentum similar to that we had back in this 2004 to 2005 period. We've also had historically bullish sentiment conditions according to the yen futures. But you also can see on this weekly log scale close only chart the prospect of a complete 5-wave Elliott wave sequence down from that March 10th high at 94.61 amidst historically bullish sentiment according to the yen futures. And as a result of the extent and impulsiveness of the November-December rally, it's not hard to endorse a major basing reversal threat that suggests that November-December rally is the A or first wave of a major reversal higher. And of course, as long as the market stays above that 81.10 low from last week, and certainly if the market can break above the 83.69 high from January 7th, we think that increasing odds should be given to a base and reversal environment that could be absolutely massive in scope, spanning quarters and perhaps even years. In sum, a cautiously bullish policy is advised in the dollar yen, with weakness below at least yesterday's 81.77 low, and preferably the 81.10 low, required to defer or threaten that constructive view. And finally, and also very interestingly, we have been approaching the gold market over the past week or so from a constructive perspective on looking at an intraday 4-hourly chart basis, the April contract shown here, since the market has been able to recover above some recent resistance spanning between about 1348 and the 1355 area. In absolute fact, at least the intermediate term trend is confirmed as up. But we'd like traders to focus on two levels that we think merit special attention. From a very tight perspective, the 1348 spot 90, a minor corrective low from Tuesday, and especially the 1325 spot 30 low from February 3rd. For if the market is on the start or has resumed a much broader bullish movement, it's absolutely imperative that the market continue to sustain its upside impulsiveness above recent corrective lows like 1348 and certainly 1325. If it cannot, then it's going to increase the odds that this recovery over the past week and a half is just a 3-wave and thus corrective sequence that, within the context of the broader slide over the past couple of months shown on the daily log scale chart here, could produce sharp losses, sharp resumed losses to new lows below 1309. This risk of this recent recovery being stemmed and reversed might be highlighted for two reasons. Number one, the fact that thus far, over the past, just as a result of the past couple of days slippage, the market has respected the exact 50% retrace of the December through January sell-off from 1432 down to 1309 at 1369 spot 40. That's the 50% retrace, and the high 2 days ago was 1368 spot 70. It's also important to note that over the course of the past month or two, there's been not only no correlation between between the gold market and the U.S. dollar index. If anything, there's been a recent positive correlation between the two. But historically, there's a negative correlation. And giving our increasingly constructive view on the U.S. dollar index, we've got to be very watchful for this relationship to return to its more historic norms of that being an inverse relationship between gold and the U.S. dollar. So in sum, a bullish policy, a cautiously bullish policy remains advised for the gold market. But if the market fails below the 1348 spot 90 corrective low from Tuesday, we're going to urge traders to quickly move back to a neutral sideline position for fear that the past week and a half's recovery might be a larger degree bear market corrective sequence in gold that could expose sharp resumed losses to eventual new lows below 1309. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.